For months, a specific anxiety has dominated the market: the idea that we've entered an AI mid-cycle slowdown and that compute demand has finally peaked. We've seen this skepticism reflected in recent tech volatility, fueling the narrative that the AI build-out was a temporary bubble rather than a permanent shift. Current market turbulence actually represents the transition point between two distinct stages of technological development. Phase 1 focused on language and coding agents, systems like large language models that are primarily optimized to answer questions and generate text-based outputs. Phase 2 centers on consumer agents. These are autonomous systems capable of navigating real-world digital interfaces to execute complex, multi-step workflows without human intervention. These agents are crossing a significant threshold. They are moving from writing code to actively spending capital to complete their assigned tasks. Managing Phase 2 requires an entirely different financial architecture. The world is realizing that better microchips are only half the equation. The real bottleneck is how these agents will actually interact with the global economy. There is a massive operational gap between a text output and an autonomous workflow. A coding agent writes a plan. A consumer agent executes it, visiting multiple sites, comparing prices, and completing the purchase of a full trip to Italy. Tech giants like Meta and Apple are pivoting their entire hardware and software stacks to support these agents, moving past simple assistance towards systems that can act on a user's behalf. Goldman Sachs estimates consumer agents will consume 30 times more compute power than today's coding agents. Unlike oil, which scales linearly with the global economy, intelligence demand is exponential. More capable models handle more tasks, creating a feedback loop where compute demand far outstrips supply. This digital demand eventually hits a physical wall. The speed of the AI build-out is currently constrained by the reality of server racks, specialized hardware, and the energy required to keep them running. This convergence creates a phenomenon known as agentic commerce. Here, AI models aren't just tools. They become independent actors that manage complex physical and digital operations. To maintain their own uptime and efficiency, these agents must participate in the market directly, transacting to secure the compute and energy they need to function. In the world of agentic commerce, transactions happen at the speed of light. Millions of agents conduct business simultaneously, interacting and settling trades 24 hours a day without pause. This presents a problem for legacy banking. Modern finance is still built on human hours. It relies on manual clearing, business day settlement periods, and it shuts down every weekend. A financial system that requires human intervention to settle a wire transfer cannot keep pace with a non-human economy. If an agent needs to purchase resources on a Sunday, the current banking system is a physical impossibility. To bridge this gap, agentic commerce requires a financial layer that is programmable and permissionless. Because blockchain networks function like code and settle instantly, they provide the only infrastructure capable of supporting machine-to-machine transactions. This starts with tokenization. By putting dormant real-world assets onto a blockchain, we can create the liquidity and active capital necessary to fund the massive energy and hardware costs of this new era. Stablecoins offer the immediate, frictionless currency required for these agents to transact. They allow software to move value across borders instantly, bypassing the delays inherent in traditional banking rails. Bitcoin serves as the settlement layer for this system. Figures like Michael Saylor have positioned it as a primary collateral asset, providing a global reserve that agents can use to back their transactions outside of centralized control. U.S. policymakers are already beginning to recognize this shift. Recent speeches and op-eds suggest that digital assets and tokenization are being viewed as necessary guardrails to ensure the U.S. remains the leader of the global financial system. The capital that previously flooded into hardware is now moving toward this digital infrastructure. As the agentic economy scales, the crypto ecosystem is positioned to become the primary beneficiary of this next stage of market expansion.